we talked about this chart in the last couple months, but I want to revisit it because it seems like every economist and their brother is popping on TV saying low odds of recession, low odds of a recession. And for those who forget or don't know, technically a recession is 2 consecutive quarters of GDP negative growth. So negative movements in quarterly GDP. What's interesting is, even though every economist is saying low odds, low odds, low odds, we've already got one data point, basically 50% of the requirements, just using Q1 GDP data. So Q1 GDP, using the latest data points, came in at negative 1.5. So I don't know about all of you on the line, but if I'm looking at Q2 of this year relative to Q1 and some of the things that are taking place within equity markets, bond markets, the fact that we're heading into Federal Reserve tightening, I would almost make the argument that perhaps things are a little more difficult in Q2 relative to Q1, which would signal to me that maybe those odds of a recession are a little bit higher. Now, what I want to caveat that with is, I think a lot of times, and maybe it's just because of the last 2 that we've been in, I think a lot of times, investors and CEOs, they view the word recession as this 4-letter word that has to mean something that looks like 2008, 2009, or 2020. Those were very unique, I would argue, pretty cataclysmic recessions. They were certainly recessions, but it doesn't have to mean sky is falling, world is ending. And if we consider the possibility that Q1 and Q2 of this year are already recessionary conditions, which they may be as we roll through time and see how the data comes in, it hasn't been too bad for certain parts of the economy. I will dive into a little more detail on some of the spots of the economy where there has been some real pain, and again, I certainly want to be sympathetic to that, but broad-based, I think things are a little more mixed, and we'll get into the detail here in the coming slides on that. One of the key data points that is very, very mixed and is certainly really front of mind when we think about how the Federal Reserve is approaching interest rate hikes and how they're approaching inflation, it's the consumer. The consumer data right now is incredibly mixed, incredibly confusing. Some of the messaging we're getting from retailers and consumer discretionary type products is very, very mixed. And I guess to give a couple examples, Target came out, they had pretty poor results a number of weeks ago. But when you peel back the onion, what they noted was the fact that they may have just been poorly inventoried for what the consumer wanted, that they had more TVs and computers and things, big durable type purchases. Whereas the consumer wanted things like clothes to go back to work, clothes to go out in, purchasing of airline tickets. So there is a chance maybe we've got this nuanced flip of just what the consumer is spending money on. I tend to think that's the case. But what we're looking at here in this slide is, on the left-hand side, it's the Consumer Confidence Index. So it's a survey done by the Conference Board. On the right-hand side is the University of Michigan Consumer Sentiment Index. And both of these are going back to basically, let's say 1970s-ish. And they're telling a very different story. So on the left-hand side, you're seeing consumer confidence actually at pretty elevated, well above average type levels. Whereas on the right-hand side, consumer sentiment looks about as bad as we've ever seen it. It looks easily as bad as some of the recessionary declines we saw back in 08, 09, even all the way back in the late 70s, early 80s. So kind of different strokes for different folks, depending on which survey you want to believe. But, I worked with my analyst on digging into how these surveys are constructed. And what we found was pretty interesting, because on the left-hand side, a couple of the key data points that drive consumer confidence are going to be things like employment, wages, which I think anybody within our economy knows we got a lot of job openings. Things are running pretty strong still, and wages are certainly ticking up. So if you contribute that to how the consumer's feeling, that makes sense that those data points would feed into a higher number. Flip over to the right-hand side, I've highlighted one particular item, which is the buying conditions of durables. So think about cars, think about big ticket items. No doubt about it, we've been in very inflationary conditions in some of those markets. And even though the consumer may be able to pay for those things, they don't really like the fact that they're having to pay as much as they are. Consider the fact that Right now, we've got airline prices that are probably about as high as they've ever been, but yet United Airlines just yesterday came out and said they're seeing absolutely no movement down in demand, despite the fact that ticket prices have gone up so substantially. So I think we've got this interesting scenario, at least within the core manufacturing world, of yeah, things are getting more expensive. Yeah, nobody likes spending more money on gasoline or plane tickets or things like that, but we've got more money in our pockets. We've got the ability to spend this, and still, even in this environment, we've got a lot of job openings, particularly within the manufacturing world. So pretty interesting scenario. I mean, obviously there are some pieces of weakness coming out that I think we want to be cognizant of. One big one is certainly going to be on the Amazon side of things. So probably 3 or 4 weeks ago, Amazon did come out and say basically that they overspent, they overbuilt on warehouses, and now Amazon is in the business of either subleasing or selling. Their estimate is about 10 million square feet of warehouse space. So you do have some real actual pockets of weakness that I think we want to keep an eye on. But more broadly, the consumer looks like it's still able to stomach much of this inflation, even though they might not like it.